Over the last few months, we have seen a flurry of new FOFs or fund of funds launches by AMCs. Now, as its name suggests, a FOF invests in the units of other mutual funds. This is an interesting concept, as in essence, an FOF can be a convenient gateway to other funds to which an investor may or may not have direct access. But FOFs are not a new product and have been around for years. Then why this renewed interest in FOFs now? More importantly, can these new offerings add any value to your portfolio? And in general, how should you navigate the FOF space? These are the questions we'll try to answer in today's videos. Hello and welcome to ET Money's YouTube channel. We will first look at the prominent reasons that have led to a renewed interest in FOFs. Then we will see how FOFs can add value to your portfolio. Now this video belongs to our playlist on fund categories. To watch similar videos, you can explore it. The link is in the description. Okay, let's begin with understanding why FOFs are hogging the limelight. As I mentioned earlier, two reasons are responsible for fund houses' renewed interest in FOFs. First is the typical business reason. The FOF space allows ample scope for innovation and there is no limit on number of FOFs a fund house can launch. So FOFs are becoming the growth areas for fund houses from a business perspective. But the second reason is even more important. The union budget for 2024 reversed course on the unfavorable FOF taxation, giving FOFs a new lease of life. Now, this unfavorable taxation had come into being after the 2023 budget. It is likely resulted in a drop in their AUM share. Actually, the taxation of FOFs can be divided into three phases. Before April 2023, between April 2023 and July 22, 2024, and July 23, 2024 onwards. July 23, 2024 was the day of the union budget. Now, before April 2023, as far as taxation is concerned, most FOFs were treated like non-equity funds and hence were subject to the taxation applicable to those funds. That meant gains booked within 3 years of purchase were classified as short-term capital gains or STCG and were taxed at the slab rate. And gains booked after 3 years were treated as long-term capital gains or LTCG and taxed at 20% post-indexation. Now, FOFs that were classified as equity-oriented of course enjoyed equity-like tax treatment. But to qualify, a fund had to invest at least 90% of its assets in ETFs, which further invested at least 90% of their assets in listed Indian companies. The union budget for 2023 removed the LTCG benefits from non-equity funds, which also impacted FOFs. FOFs were then taxed at the slab rate irrespective of the holding period. However, this change applied only to non-equity funds purchased from April 1st, 2023, not those purchased before. The 2024 budget further revised this taxation and it was made applicable only to those funds which invest 65% or more of their assets in debt instruments or in a fund that does so. So most FOFs came under the uniform 12.5% LTCG tax rate if held for at least 2 years. For periods less than 2 years, they continue to be taxed at the slab rate. Now, the revised tax rate of 12.5% on long-term capital gains has made FOFs quite attractive for those in the higher tax brackets. However, the changes in 2023 and then in 2024 have resulted in a hodgepodge of what tax rules are applicable for what investment periods. Now, we have decoded that in an earlier video. I've included its link in the description so that you can watch it later. Okay, cut to the present. FOFs are now back on the growth path. As of April 2025, the FOF space already had 157 funds, commanding an AUM of about 1.24 lakh crore. Alright, let's now examine some use cases of FOFs and how they can add value to investments. But before I start with that, please subscribe to this channel and don't forget to press a bell icon so you never miss a video from us. Post the Union Budget 2024, returns from debt funds are taxed at the slab rate, irrespective of the holding period. For those in the higher tax bracket, that means a 30% tax. So a 6-7% return from a debt fund would come down to just 4-5% post-tax. However, with income plus arbitrage FOFs, you can earn debt-like returns without the corresponding taxation. Income plus arbitrage FOFs invest in debt and arbitrage funds so that the net debt exposure remains under 65%. This construct helps them avoid debt-like taxation. Now, while such funds invest partly in equity via arbitrage, that's not a risky strategy. The arbitrage strategy seeks to generate returns from the price differential of securities in the cash and the future markets. As such, it's a low-risk investment method that seeks to generate debt-like returns. Overall, you get debt-like performance but not debt-like taxation. Let's look at Kotak Income Plus Arbitrage FOF, which is the largest FOF with an AM of about 1250 crores. The fund primarily invests in Kotak Corporate Bond Fund and Kotak Equity Arbitrage Fund. Overall, currently, there are 15 Income Plus Arbitrage funds available. A look at the recent returns of some Income Plus Arbitrage FOFs suggests that their performance compares well with pure debt categories. However, do keep in mind that Income Plus Arbitrage funds are a relatively new sub-segment. Many fund houses have repackaged their existing schemes as Income Plus Arbitrage funds, so their performance is yet to be tested over longer periods. Now, this brings us to the next use case of FOFs. As their name suggests, multi-asset FOFs invest across asset classes and hence help you derive the benefits of asset allocation. For instance, consider the portfolio of HDFC Multi-Asset Active FOF. The fund's top holdings are HDFC FlexiCap Fund, HDFC Large Cap Fund, HDFC Short Term Debt Fund, and HDFC Gold ETF. So the fund has spread its assets across equity, debt, and gold, and this helps you achieve diversification within one fund. With these FOFs, you enjoy not just benefits of diversification, but also tax efficiency. How? Let me explain. When you buy funds separately for asset allocation purposes, you need to rebalance your portfolio from time to time. This rebalancing may involve selling part of the funds too. When you do so, there will be a tax incidence. However, when you invest via multi-asset FOFs, you don't have to rebalance your portfolio yourself. Your fund manager does so based on the market conditions and the fund's objectives. Now, when mutual funds rebalance their portfolios, there are no tax incidents for you, and this saves you tax outgo. Now, some of the largest asset allocation FOFs along with their historic returns are on your screen. Over the last 1 year, these funds have done better than Nifty 500, possibly due to their gold exposures. Over the last 3 years, their performance is quite comparable to the Nifty 500. Their debt exposure also potentially makes these funds less volatile than pure equity funds. Now, at this juncture, it's important to differentiate between multi-asset allocation funds and multi-asset FOFs. Multi-asset allocation funds are a type of hybrid funds, where the funds invest in individual stocks, bonds, and gold. On the other hand, a multi-asset FOF doesn't directly invest in securities. Rather, it invests in other funds. So, an FOF ends up being even more diversified given that the single fund itself has multiple securities. Obviously, that reduces risk but can also dilute the performance of a good underlying fund. Okay, let's move to the next application of FOFs now. There are FOFs that invest in the schemes of other AMCs either partially or fully. By doing so, such FOFs can act as a portfolio of funds. For instance, consider Aditya Birla Sun Life Financial Planning FOF. It invests in the schemes of several other AMCs across asset classes. This FOF has 3 variants: aggressive, moderate, and conservative plans. Take a look at the current portfolio of the aggressive plan. The top schemes of this FOF include ICICI Prudential Blue Chip Fund, Nippon India Growth Fund, ABSL FlexiCap Fund, Kotak Multi-Cap Fund, and HDFC Large and Mid-Cap Fund. The fund also has exposure to a gold ETF, a corporate bond fund, and a GSEC fund. So this fund and others of this type also double up as asset allocation funds. Now consider another fund, Axis Equity ETF FOFs. This ETF invests in ETFs from other AMCs apart from its own. The constituents of this FOF are Axis Nifty 500 Value 50 ETF, ICICI Prudential Nifty 100 Low Volatility 30 ETF, ICICI Prudential Nifty 200 Momentum 30 ETF, and SBI Nifty 200 Quality 30 ETF. However, there is one thing you need to keep in mind here. While multi-AMC funds can serve as a portfolio in themselves, the quality and appropriateness of the underlying funds are something you need to consider. If the underlying fund is not that great, you wouldn't want it in your portfolio, right? And if the underlying fund doesn't match your requirements, there is no reason why you should consider the FOF that has it. This brings us to the next application of FOFs. Many FOFs invest in overseas ETFs and funds, and that way they can provide access to international markets. Apart from deriving the usual benefits of diversification, this helps you invest in businesses, sectors, industries, and themes that may not be readily available in India. However, there is a catch here. Not all international FOFs are open for investments. That's because the international investments by Indian mutual funds is already hovering around the RBI mandated limit of $7 billion. Fortunately, quite a few continue to be open. How? Well, that's because in addition to overall $7 billion limit, there is also a fund house-wise limit of $1 billion. And for overseas ETFs, there is a separate industry-wide limit of $1 billion and fund house-wise limit of $300 million. In 2022, SEBI allowed individual AMCs to continue accepting fresh investments to the extent of the unused portion of their $1 billion fund house-wise limits. And that's why many international funds remain open for subscription. Now, top 10 schemes by AUM which are still open for investments are on your screen, along with their return picture. This brings us to the fifth application, which many of you would already be aware, but still deserves a mentioning. It is well known that investing in ETFs requires a demat and a trading account. If you also invest in stocks, you would already have one. So investing in ETFs is not a problem. However, if you're a fund investor who doesn't dabble in stocks, opening and maintaining a demat account for ETFs can be a hassle. Demat accounts also have maintenance charges, so even if you don't use them, you still have to pay the cost involved. Now, for such investors, FOFs can be immensely useful. Today, many ETFs also have an FOF variant that makes it convenient to invest in them indirectly. This is especially useful for gold and silver investments. Most gold and silver ETFs have a corresponding FOF to facilitate investments in them. So, these are the 5 primary ways how FOFs can add value to your portfolio. But does investing in FOFs have any disadvantages too? Yes, and they are important too. Let's see them in the concluding section of the video. The tax change for FOFs in 2024 is expected to usher in a new era for them. That means more FOFs offering in the time to come. That's both good and bad. Good because as an investor, you will have many more options and some of them can be quite interesting too. Bad because the rise in the number of schemes can result in greater confusion. If FOFs continue to grow without any oversight, it would get difficult to separate the worthy ones from the crowd. Another issue with FOFs is their dual expense structure. When you invest in FOFs, you have to pay not just the expense ratio of the FOF, but also the expense ratio of its underlying funds. This can raise the cost of investing in FOFs, consequently pulling down your returns. The unavailability of many international FOFs for fresh inflow is a concern too. So far, the RBI has been unwilling to revise the international limit of $7 billion, which was set way back in 2008. This can keep a powerful investment vehicle closed for investors for the foreseeable future. Still, even in their present avatar, FOFs have plenty to offer, and based on your requirement, you can take your pick. And with this, we have come to the end of this video. I hope you found this video useful. If you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.